Hi guys, so I just want to talk about this Reddit post about the three type of investors. Someone ran the calculation of the S&P 500 dating back to the last 40 years, and they account for three type of traders. One who invested in absolute worst time, one who was able to time the bottom and invest all their money in the absolute best time, and one who invests their money constantly every month regardless of how bad or how good the market is performing. So they use a spreadsheet and historic data of the S&P going back to the last 40 years, and each trader save about $200 a month of their income over the next 40 years, totaling about $96,000 to invest in the stock market. But three of them invest very differently. So the first one we have Tiffany's terrible timing. So Tiffany, for her, she put all her money into a savings account which earned a 3% yield, and she first invested a lump sum at the absolute worst time in 1987, which is Black Monday, where there was a 33% crash. So she invested a lump sum of that money right before the crash, but she held it and never sold. And then she saved more of the money into the savings account again, and then it wasn't into 2007 financial crisis. Right before then, she invested another lump sum of the money she saved right before the 2007 financial crisis crash. So again, it was bad timing, but then again, she held and never sold. And after the 40 years, her $96,000 still yield her up to $663,000. So in the end, she still more than like triple her money investing in the S&P 500, even though it was like the worst time possible. She was able to grow her money from $96,000 to $663,000. Next, we have Brittany buys at the bottom. So Brittany, like Tiffany, so she saved her money again every $200 every month to put in her savings account, which yield a 3%. And then she went in a lump sum like Tiffany, but this time Brittany was able to time the very bottom. So she saved her money until 1990, and she invested it during the 19% crash during the Middle East war. So there was a 90% crash, and she invested it right at the very bottom of it. And she saved her money again, and again in 2007 during the financial crash, there was a 56% drop in the stock market, and she was able to time that, and she invested it again at the very bottom. And so over the next 40 years, she was able to, her $96,000 grew to $956,000. So if you compare Brittany to Tiffany, Brittany was able to get about a 44% gain compared to Brittany, because again, Brittany was able to time the bottom, but Tiffany wasn't able to time the bottom. She always invested it during the peak, so at the absolute worst time. And then last but not least, we have slow and steady Sarah. So Sarah took a very different approach. So she did not put any of her money into a savings account. She invested the money every single month into the stock market, no matter how well or how bad it was doing. So she put in 200 every month into the market, and over the next 40 years, her $96,000 actually grew to $1,386,000. So in the end, she was able to beat Brittany and Tiffany. So if you do a recap, so $96,000 was invested. There was three types of investor. You have Tiffany, who invested at the absolute worst time in the market, and her $96,000 still grew to $663,000. And then you have Brittany, who was able to time the market, invested a lump sum in the absolute best time, and her $96,000 grew to $956,000 in 40 years. And then lastly, we have Sarah, who auto invests, meaning she invested $200 every single month, no matter how well or how bad it was the market was doing, and her 96,000 grew to 1,386,000, which really go to say that time in the market is more important than timing the market, because we can't really time the market. No one can really time and know when is the bottom and when is the peak. So it's maybe best to just invest the money, and if you are down, you can average cost dollar every month. So with that article, it really highlights the quote, time in the market is more effective than timing the market, because you can't really predict the top and the bottom of a stock market. Even the best investors and computer algorithm out there still does not have been able to time the top and the bottom of the market. And what that quote means is that it may be in your best interest to buy at a consistent rate, like every month or every week. Put it in stocks that you believe in, that you did research on, instead of just keeping your money on the sideline and then waiting for a market crash and then trying to time the bottom and then you put your money in. Because every time your money is not exposed to the market, you are losing the opportunity to gain money, to gain interest, to gain the small amount of rallies that the market has to offer, because you are waiting for a big crash. And so for most investors, I think it is in their best interest to just kind of buy at a consistent rate every month, so that even if you are down, let's say you're down like 10 or 15%, if you continue buying, your average is gonna slowly goes down. So when the market does recover, it takes less time for you to get your money back and to be in profit, because you have been buying at a lower price consistently during the stock market crash. And so when there's a new rally coming up, it will take less time, and that's when you can be in the money finally. And so it might be best to just kind of keep your money exposed to the market. Of course, only money that you can afford to lose. Don't put your whole life investment into like a stock. Try to diversify, and try to keep your money exposed to the market, based on your risk tolerance, of course. And as you can see, all three investors at the end made money. Even the one that invested in the worst time, Tiffany's terrible timing, she still made more than 4x of her money over the next 40 years. So it is profitable to invest in the stock market, and you just gotta go based on your risk tolerance.